Well, new data today from the Vancouver Real Estate Board shows that both home prices and sales increased in September versus the year before. Inventory also jumped. Meanwhile, the benchmark price, as I mentioned, prices were up. It went to just over $1.2 million. It's a different story here in Toronto, though, as data from earlier today showed home sales declined and prices fell for a second straight month.
It is a reflection of a rebalancing of the market after springtime that has been a lot more robust than probably most of us had expected, with prices rising for around five consecutive months. So the last 2 months, we've seen a little bit of rollback of that activity slowing down.
Well, moving from residential to commercial real estate, this market remains more in limbo as buyers, sellers, and lenders all try to get a handle on the value of properties in the current interest rate environment. But asking rents remain high for both office and industrial real estate, according to the commercial real estate firm Colliers Canada. Joining us now is Brian Rosen, President and CEO of Colliers Canada. Brian, thanks so much for coming in.
Thanks for having me in.
So give us a sense of what you're seeing in the commercial real estate space right now.
Yeah, I think you articulated it well. Right now, there is a pause in transactional activity, and it's been that way for most of the year. Really, with interest rates going up as fast as they did over the course of the last year, it put a lot of uncertainty in what would happen, and therefore you had a lot of price discovery, a lot of unknown values of where things were going to settle. And as a result, lenders have been very stingy. Buyers and sellers have a very different perspective on pricing. And as a result, there's not been many trades, and therefore there's not a lot of comps in terms of the price points.
So it's hard to sort of understand what the value of these properties is at this moment? Exactly.
So part of the challenge is that with rates have gone up, so the lending would be, in theory, more expensive, but there isn't a lot of lending going on right now, and there's also not a lot of trades. Without trades, there's not a lot of comparables. So patient money will stay on the sidelines, wait it out, see what happens, and unfortunately that results in just a pretty much of a stuck market right now, and it's been that way for most of the year.
So if we keep hearing this idea that interest rates could stay higher for longer, does that mean that this freeze would continue for quite some time, potentially?
Well, I think the one difference is certainty versus uncertainty. So I think right now there's still uncertainty on where the interest rates are going to go. Some of the trends are starting to show a slowdown in the economy, but it's a little bit up and down. And until there's certainty that interest rates have stabilized, there's not going to be as much activity because we don't know, are you going to be the first fool over the barrel, so to speak, over the water, because you're buying when the rates are going to be different in another month. So once there's stability, trades will start resuming, and then you'll start to see that equilibrium found between the buyer and the seller, and that'll start stimulating the market activity.
Let's take a look at some of the data that your firm has collected when it comes to vacancy rates, but also to rent prices in office space, because rent prices are still high, even though you hear about vacancy rates also being elevated. I think we've got a graph that shows the comparison there for office space, but maybe you can give me a bit of a sense when it comes to that side of things. There it is there. So vacancy rate climbing, but so is the asking rate for rent.
Right. So there's two forces at play. The biggest one is mix. So mix is the most important right now, where you have a lot of the AAA assets, the really high value assets are adding supply into the market. Their rates are going to be higher than you're going to find in suburban office, you're going to find in the Class B and C buildings. So that really helps stabilize some of the rates, which is offset by obviously some of the more competitive pricing that you're seeing on the rates in the market. The other thing is rates are the last thing to move. So incentives start coming first in terms of tenant improvement allowance, in terms of other things, free rent, things that landlords will offer up to keep the head rent stabilized. So that will eventually go down. We've been around for 125 years. We've seen the cycles go up and down, and that will be the next thing. But right now, the mix is really helping keep the price point up.
That is interested on the incentives side of things, because that can be short term. You can do that, even for a year, but not be locking into a lower lease. And these leases tend to be quite long too, if you're looking at office space, right?
Although the incentives are really valuable because the cost to outfit, and that's one of the things also causing such the deferral and delay of activity. And you're saying what's causing pause? People don't know if what the future of their office space is going to be, because the cost to outfit could be $200, $300 per square foot, which is really an obstacle to doing something. So those incentives can be very valuable if a landlord is going to foot that bill, because you look at it as from a total financial outlay as a company. And so that does actually have a meaningful effect in the near term and midterm.
We've got another one of your graphs on the industrial space comparing, again, the asking rents and vacancy. And you can see there that the asking rent is really increasing, but that vacancy rate is somewhat more level. Can you help us read what this is illustrating?
I mean, you can see the vacancy is at absolutely low amounts. I mean, it was sub 1% in a lot of markets across Canada. So what you're seeing with the rent is it's pricing to supply. There's really just a lack of supply in the market of industrial. So even now, where there's been a little bit of a slowdown in terms of demand, it's still climbing up to 1%, which is below a healthy market. It's way too low of a supply. So the rent has gone up to adjust for that.
And the industrial that we're talking warehouses, the sort of, think Amazon shipment centers, that sort of thing, when you're thinking industrial.
So whether it's owner-occupier, so a small business, whether it is an Amazon large distribution center, there's a lack of land that's zoned for industrial, combined with a huge demand exacerbated by the pandemic, where e-commerce and a lot of those other macro factors that drove that, nearshoring, et cetera, you end up with a higher, and rents were historically low relative to other major markets. So this was a little bit of a catch up in the last few years. So it's stabilizing a little bit, but it's obviously gone up in the last few years.
We're almost out of time here, Brian, but we do have one more graph of yours that I want to bring up just because it gives your sort of prediction of the future. Can you tell us a little bit about what we're looking at here?
Yeah, I think that we have been surveying clients for the last year. We have a property management firm that has 35 million square feet under management. So there's a lot of tenants that we end up interviewing. And the general trend is we do see the vacancy going up over the next year. I mean, that's consistent with what you're seeing in the trends, people taking less space. We do see it stabilizing, though. A lot of macro factors, a lot of strong fundamentals for the commercial real estate market and office in Canada, immigration, education, job growth. Eventually, in the long term, will fill back the offices, but we do see it getting a little bit worse in the near term.